Massive rate cuts could be coming. Boy, this is just a freaking cluster F. Every day it's like a different freaking story. Today, we got State Street. They manage $3.6 trillion in assets. They're the fourth largest asset manager in the world. $3.6 trillion. Not billion, $1 trillion. That's how much money they manage. And they probably take like, a 1% fee on that, which just for giggles, geez, I have to use AI to do that. 3.6 trillion times 1%. Let AI think about it in real time, and I'll let you know when it answers. It's so bad. It's just a lot of money that they're probably going to be making. But the point is, they are now betting on massive rate cuts coming this year. Now, this is interesting. 1%, by the way, of 3.6 trillion is $36 billion that this company can print if they charge 1%. That's crazy. So they make lots of money. And they have a bet that massive rate cuts are coming this year. Now, what's interesting is they were one of the first to bet that massive rate cuts were coming at the end of last year. See, if you go over to, I believe it was October. Yeah, see, we were in the third month of a 3-month sell-off in October. All of October was basically red. And we U-turned at about November 1st, and then we got a dovish Powell in December, and things basically just rallied from November 1st on, accelerated by Powie Wowie. So here, we get October 3rd. What do they say October 3rd? We could see 100 to 200 points of easing as growth and inflation slow in 2024. Yet, what's interesting is, if we look at real GDP forecasts, based on the Atlanta Fed, we haven't really been slowing GDP. We're actually doing very well. We're sitting in the 2.5% to 3% range for GDP, and the blue chip consensus, or the market consensus, is actually moving up. That's because we're upwriting what we think companies are going to provide in terms of earnings, and the economy is actually doing stronger. But State Street disagrees, and they actually think we're going to get big cuts this year. And I'm going to talk about why. But I have to say, this morning was absolutely wild. At about 10:27 Eastern Time, during our course member live stream, we shorted live. We did a live short right about here. And the entire market at 10:27 took a whole leg down. The Qs, everything. I don't think I started that. I don't think we have that kind of magic one. But I'm just saying, if you ever doubt real-time trading, not only did we take a $4,500 profit this morning, but we took another $1,800 real-time during the course member live stream. I'm like, we should short Sunrun here. Boom, picked up $1,800 on the way down as the entire market moved. Now, that was awesome. Like, we shorted it that minute. But I just want to mention, if you want all of these alerts, why are you not in the Stocks and Psychology of Money group yet? Link down below. You can get access to the Stocks and Psychology of Money group. I can't guarantee every trade is a win, but I'll send you my trade alerts. When I think I've got something that I think is a good move, I'll send a trade alert, and you get all my trade alerts, get lifetime access to those, and you get lifetime access to the course member live streams, so consider joining those. But for now, let's focus on State Street for a moment. So State Street is making the argument that because of consumer debt buildup and a potential slowing of the economy, we could actually see still 150 points of cuts this year. They say a string of robust U.S. economic data, including Friday's blowout jobs report, has sort of suggested that maybe we don't need rate cuts. But they maintain that the economy is not actually as strong as it seems, with indicators like credit card delinquencies and the cost of credit to small business pointing towards a downward turn later this year. Let's be clear, smaller business is paying for higher rates right now. They're the ones footing the bill. It's not the big companies, it's not the mega caps, the big growth companies with the massive money market profiteering that's going on. Look at a company like Microsoft. They pay $500 million in interest. They make nearly $1 billion in interest. It's over $900 million. It's crazy how much money they make because they have so much more cash. That's the opposite for small businesses. Small businesses get screwed. And so State Street actually thinks the market is, quote, underplaying the likelihood of deeper cuts. And there's a lot to suggest that the recovery is very fragile, despite that it looks resilient on the surface. And of course, we have a chart here suggesting the market is actually unpricing 3 cuts, which would be negative 75 BPs here with about negative 61. And so they actually think that with inflation going closer to 3%, you don't actually need rates this high. And so initially I'm like, what are y'all smoking? Like, the data's coming in hot. And credit card delinquencies, yes, they're high, and debt is skyrocketing. This is true. But I don't know that we're going to have a catalyst of those debts coming due yet. We will have a glorious recession at some point in the future, and it will be driven by a consumer debt cycle. I have no freaking idea when that's going to be, but I don't think it's now. Now, as far as this 3% argument, I tried my best to think, okay, what can we possibly say? Well, there are a couple things we could do. First, we could look at what Nikki T says. So Nikki T, good old Nikki Leaks, okay? Nikki T gives us basically, you could take the over or the under, and you might be right. He says, the March CPI, which comes out tomorrow, could validate or upend the idea that hotter than anticipated inflation readings in Jan and Fed reflect blah, blah, blah changes, right? Basically, tomorrow's CPI report at 5:30 a.m., I will be streaming it live, obviously, is extremely important because we're going to either amplify that we are hot, or we are going to reiterate that those early numbers were a fluke and we're going down with CPI. We're expecting 0.3 on the month-over-month, 0.3 on the month-over-month core, year-over-year 3.4, that's actually up from 3.2, and the year-over-year core down to 3.7 from 3.8. Now, if I go to the most important one, which is the CPI core month-over-month, the super core is going to be very important, but I want you to know that the ranges right now are pretty tight. They're pretty tight between 0.25 and 0.35, with a high estimate of 0.4 and a low of 0.2, with 60 qualified economists reporting. We could get a big miss here. If we get a 0.4, the stock market's going to plummet because there's like one economist predicting 0.4. There's one economist predicting 0.4. And then you have 6 predicting 0.2, and the rest are at 0.25 to 0.3 to 0.35. So a miss to the upside would be really unexpected and bad. And it would reiterate hot January, February market go down, right? But could State Street be right? Yes. If we got a 0.2 handle tomorrow with only 6 economists, so 10% of economists thinking we're going to get a 0.2 handle, that would be really good, especially if Supercore comes down. What do we need for Supercore to come down? I'm going to tell you. Vehicle insurance, homeowners insurance, medical, pets, financial services, all of those service industries down. Very, 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 very important that we get weaker price growth in those. We already know oil is going to contribute to up on a headline. That's fine. But what else do we need to pay attention to? And remember, I'll be live at 5:30 a.m. tomorrow. It'll be on the Meet Kevin live channel, so make sure to watch me there. And then we'll post a summary on the main channel later. But anyway, what do we have to consider when it comes to State Street? Could they be right? Okay, so what I did is I wanted to try to see how could they be right. And what I did is I went over to the multivariate core. I posted this over on ehack.com as well. So you could just Google this, multivariate core inflation. And what you have to remember is we raised rates to 5.5% to get multivariate core down from the crazy levels where it was. Here's multivariate core. Multivariate core, let's just get rid of headline here because that's so lumpy. Let's just get the probability band. So let's get rid of all this stuff. Okay. So we raised rates to 5.5% to kill multivariate core that was between 4.9 and 5.6, right? This probability band over here. So we go to 5.5 to get down something that's at 5.5. Well, now what was at 5.5 is actually at basically 2.75. Okay, so we went down by 2.75. So yes, theoretically, could you get 2.75 down by reducing rates, as State Street says, 3 times 50 basis points, 150 basis points? Yeah, you actually could. You could. I'm not sure because we are starting to see some heat from wages. I don't think you're going to get a cut before probably September. But could you then get 350 basis point cuts? Yes, you absolutely could. But it's all going to start with tomorrow's numbers coming in soft. You want super core coming in soft. You want a 0.2 on that month-over-month core. And then stocks are going to go moon. So what you should be doing today is you should be doing your analysis today, and you should be going, what stocks am I going to buy with the cash you have if rates come in low or inflation comes in low tomorrow? Well, obviously, Tesla and Enphase are perfect interest rate sensitive candidates. Sunrun is very volatile and interest rate sensitive. First Solar might be an option. But you might also consider that those are going to move the indices up. And when the indices move up, maybe it'll also move up your AI place. Probably would. So probably everything will go up if you get a 0.2. It probably doesn't matter what you buy. The problem is the data comes out an hour before the market opens, so, some of the price gains will already be built in. But you'll be setting up a month of probably just... because you'll finally have put the fire out on January, February. Really big deal. If you just get a meet of expectations tomorrow, it puts all the pressure on the next Fed meeting, which is May 1st. So that's in about 3 weeks. So that's a little lame. So again, if you get a meet, it's going to go into the details. Super core, we have a debate. Which way do we go? I don't know. We'll have to analyze. If we get a 0.4, sell everything. Maybe AI won't sell off as much. Maybe. So I don't know. It's a big day tomorrow. It's a really big day. And as you can tell, Nick T has no freaking idea. Everybody this morning for a moment thought that maybe the data's already been leaked. I mean, that's possible. But what you're going to find is the Qs are just basically playing the lines. We were live trading this morning in the course member live stream, and we saw the Qs come basically hit this line and just basically move along this line. People still think the lines don't work, and the lines are great. We were live trading this, so it's not like we added the line afterwards. The same thing was true of Tesla. The bounces that we got right on the line, it's remarkable. And the same thing over here at 178. The failed breakout twice. The lines are great. If you're not using the lines, you're missing out. So join us in the Stocks and Site group. We do an amazing course member live. This morning, we're actually doing a review of a real estate analysis as well as analyzing an AI company I actually want to expand a position into. And we were tearing apart someone's real estate deal. Let's just put it that way. Anyway, those are my thoughts. Thank you so much for watching. I appreciate y'all. I guess I could mention that if you ever want to live stream and multi-stream, you could go to metkevin.com/StreamYard. They're pretty awesome. It's a paid promotion. metkevin.com/life to get life insurance in as little as 5 minutes. Also a paid promotion. And yeah, that's all I got. And then the course is over at meetkevin.com. Thanks so much. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.